What's going on, guys? So in this video, I'm going to be going over my top 3 stock picks for the month of November. And each of these stocks is going to be focused around a different type of market situation we could be going into. So one of the stocks is going to be focused around, say, if all of the US markets rebound, the emerging markets and the Chinese markets start to rebound, what do I think is going to be the most interesting slash best risk or reward as far as opportunity goes? If the market just kind of continues to like putter along and just go up and down consistently with just, a lot of volatility, where do I think a company is going to have a nice catalyst from that will, probably boost it up regardless of what's going on in the overall economy? And then I also have a company that if you think that the market, is pretty much, it's due for a correction, we're going to be going down from here, we already hit our highs, and, it's just going to be a slow, like, drain down to the bottom. There's a company that is extremely defensive that I think is also trading at a reasonable value. And so I'm going to go into all of those. So if you guys haven't, make sure to like and subscribe. I try to pump out as many videos as possible. And if you guys want me to do an in-depth analysis on any of these companies, let me know in the comment section down below. And if you guys have any other picks for the month of November, I'd be really curious to see what you guys have to say so I can, maybe look into another company that I haven't paid much attention to. But anyways, let's jump right into it. So the first company on my list is Starbucks. Now, Starbucks, I've brought up on this channel a couple times before. Starbucks is definitely the company that if you think, the economy is due to make higher highs and you think that China especially is going to start to rebound eventually, whether you think the China tariff issue is just kind of overblown right now, Starbucks is definitely a very interesting play that I think could, become very lucrative for a couple of reasons. First off, just as a side note, Bill Ackman actually, when I did my first video talking about Starbucks, Bill Ackman had just pretty much announced that he owns $900 million worth of shares that he picked up not too long ago. So I made mention of it that when Starbucks had their massive sell-off, I started buying shares, around like the high 40s, low 50s range. And Bill Ackman actually finished his entire purchase with the average price of $51 a share. So theoretically, Starbucks isn't that far away from where one of the most, renowned investors of our time just solidified a major stake for his portfolio. And so he believes that, due to a lot of other things that I'm going to be getting into, he kind of agreed with a lot of the things, or he kind of had the same reasoning as to like I did and the majority of other Starbucks bulls out there had, was that the company has the ability to double or triple, and it's not overvalued. So, obviously there are some hurdles that Starbucks has been going through. It's been kind of going sideways for the past year. But assuming that Starbucks is able to execute on, the next couple of things, especially involving China over the next couple of years, if it can execute on it properly, you will have a 2 to 3 bagger just off of, only what happens, say, in emerging markets. You don't really need to change anything that's going on in the Americas to have Starbucks gain massive potential. And so that's kind of focused around, if you look at, say, the amount of stores that Starbucks built last year, they were pumping out, I think it was a store every 15 hours or something ridiculous like that. And so they are betting heavily that the Chinese middle class is going to enjoy Starbucks, number one. It too is going to continue to grow for the next few decades. They've been in China for, about, I think, 18 or so years now, but they have been heavily investing in China over the past couple of years. And so they definitely see China as a major growth opportunity, in the future. And if you guys have been paying attention, Warren Buffett and Charlie Munger also think that, the Chinese economy is going to be pretty much the big powerhouse, a couple decades from now. So it'll be very interesting to see how that plays out. Another side thing, which is kind of like the fail-safe that comes to investing with Starbucks, is Starbucks has really been focused around becoming a dividend growth machine over the past years. So if you look right over here, its current dividend yield sits around, like a 2.5, but it's been increasing its dividend yield for the past 9 years at a rate of 23% per annum, at least over the past 5 years. And so when you think about like how quickly a company like Starbucks is building up their dividend without deteriorating their revenues or anything like that, because while they're vastly expanding, they realize that, okay, these are my set costs. I'm going to generate a lot more capital, especially if things go well in China, so I can just start dumping that back into my, shareholders. They also just announced a $5 billion share buyback program, and they said that they were going to continue to raise the dividend. So it's definitely an interesting value play. If you were invested in China just for a couple of years right now, you'd be sitting at a 6% or so yield on cost off of doing nothing, not even looking at what the capital gains were. You could have an immense dividend, potential aristocrat. Who knows what happens in the next decade or so? You could have a massive position in Starbucks just by passively letting it accumulate dividends. So it's definitely pretty interesting. When I first started buying into Starbucks, it had a much more attractive PE. Its PE was sitting around 15, and now it's between 19 and 20. Ford's looking at 18 and 19. So definitely, I wouldn't say it's undervalued. Like, Starbucks is definitely like accurately priced. I do not think that, I think that all considered Starbucks is at a fair value as a price right now. However, if the things that happen in China can execute properly, Starbucks will, looking back in a year or so, will become extremely undervalued. So it's going to be really interesting to see how they're able to execute on this. And, going forward, if China pans out correctly, so if you're bullish on the Chinese economy at all, and you believe that, say, they will continue to love the Starbucks brand, Starbucks will probably make a lot of money. Their only real downside is that Starbucks does have a decent amount of debt. However, they just acquired, the $7 billion from the Nestle deal to sell their products. So if they start throwing that towards their debt, they'll definitely have no issue, even during a recession, keeping the doors open and continue to grow and continue to just kind of get everywhere to the point where you think that you see McDonald's and it's actually Starbucks. So Starbucks is definitely one of the stocks that I'm keeping a very close eye on. And also, just a quick side note before I go on to the next one, is that Starbucks has been holding its own very well when you look at it compared to the broad market the past month. If you look at the volatility and you look at the direction, Starbucks has been slowly gaining traction and kind of not dealing with what's going on in the overall market. So very interesting play. Next, so Nintendo. Nintendo is definitely a company that I think is going to have either massive up or downside this holiday season, regardless of what's going on in the economy. And that's mainly because you have to realize that even if, say, we hit a recession, it takes some time for it to actually hit the end consumer. And so being a game company like Nintendo is really going to be making the majority of its money this year from its holiday sales. And so regardless of if the economy is going up, regardless if it stays the exact same, Nintendo could possibly get, a massive pile of cash from consumers this holiday season. And my reasoning for that is because Nintendo is, kind of being the picture-perfect turnaround of the past couple of years. When they introduced the Nintendo Switch, they successfully stopped their product cannibalization between their, like the Wii U and their DS series. And now they're focused on one platform. They're able to sell games on this one individual platform and not have to have individuals decide between one or another. And you also allow a much easier platform for, third-party games such as, say, Fortnite to get onto the platform to make it even more of a compelling opportunity for people to buy it. So you're no longer restricted, to just Nintendo games, except for like the occasional like Call of Duty and things like that the majority of people have had to deal with Nintendo games for a long period of time. So the Switch is kind of an improvement in all areas, in my opinion, for their console lineup. Another interesting thing is that Nintendo has two major blockbuster games coming out this holiday season, and I personally think that is going to not only levitate their game sales, but also severely bump up the amount of Switches they sell compared to what analysts are expecting. The Switch is currently the #1 gaming console in the world, but because sales are slowly, or slightly slowing down, analysts are kind of freaking out like, okay, this is it. They need to make a Switch 2, otherwise it's all over. I personally think that a lot of people are holding off on buying the Switch because of these two games. And the two ones probably have the biggest following, Pokemon being the biggest franchise in the world and the biggest franchise now of Nintendo. I believe it's even bigger than Mario. I definitely think that the new Pokemon Let's Go Pikachu and Let's Go Eevee revamps of the original game, introducing, aspects from Pokemon Go and all the other fun additives that the Nintendo Switch now has in it. I definitely think that that's going to be a huge selling point for kids. And the new Super Smash Bros. Ultimate is a wildly anticipated game that is going to be, the biggest Smash Brothers ever. And Smash Brothers in recent years has become one of the fastest growing esports out there. It's obviously not anywhere near the size of, say, League of Legends or Overwatch, but it is definitely growing its very, devoted community base. And I highly anticipate them selling pretty much out, in, if not thousands and thousands and thousands of copies when this comes out. And so if you look at their, say their balance sheet, they have almost $8 billion in cash, and they have zero debt. So this company doesn't have to worry about going bankrupt. It's growing at a very fast rate, because again, it's the turnaround type situation, so you kind of have to expect that. But the revenue is up 82% year over year. So definitely executing really well, and the only issue that analysts seem to be seeing is that this growth could start to be slowing down. But if you look at the analysts, say that are covering Nintendo and that have price targets for it, the average price for Nintendo ranges anywhere between $60 and $70 a share, and it's currently trading around $40 a share. So there's a massive potential upside for Nintendo over the next few months to a year. So I would highly consider looking into Nintendo. And so my last company is going to be, the defensive play. If you just want to slowly, put a rock in your portfolio, slowly accumulate cash flow, and not worry about what's going on in the market, and say if the overall market dips, have, this solid investment that should dip lower than the average market and continue to generate a nice cash flow. And that is British American Tobacco. So this company is one of the largest tobacco companies in the world. Obviously, they produce cigarettes, they produce, heat up products, and they produce vaping products. Now, about a year ago, British American Tobacco bought the Reynolds American, which is the company that makes, say, Camels and, Pall Malls and other cigarette brands here in the U.S. So they have finally, kind of wiggled their way into, the U.S. territory, and they've, started to take away market share from, the company Altria, which kind of, makes Marlboro here in the U.S., and they're the parent company of Philip Morris. So definitely, they're up against some tight competition, but now they're finally exposed to here. But I don't really care about that, because the really interesting play is that between British American Tobacco and Philip Morris, they're exposed to the emerging market category. And the emerging market category is the only growth trend that is positive in the world for cigarette consumption. So if you look at, especially in the Asian countries, they actually have increasing amount of smokers. When you look in America, it's relatively stagnant. We did see this past year, we saw a slight bump up, but the overall trend is very negative as far as the amount of people that are smoking. And obviously, for those of you that don't want to be invested in any type of sin stock, this company isn't for you. But you have to think about something from an investment standpoint. If your goal is to just make money, this is the kind of way I see tobacco stocks. You have a company that has an extremely dedicated fan base, for lack of a better word, and they have the ability to, say if their overall, fan base goes down, they have the ability to increase prices without increasing costs or anything like that. And all of their customers, for lack, give or take a couple of percentage points, will continue to buy, so they can continuously increase their earnings without having to, really spend any more capital, and just continuing their operations. It's almost like gas in a sense, that they can just, increase price, and what are you going to do? You're not going to go get your smokes. Oh, you're not going to go, fill up the gas tank on your car. You just have to do it. If you smoke, you smoke. At the end of the day, you're just going to continue to smoke. And they've been expanding, in oral tobacco and a couple of other regions. Pretty much every tobacco area British American Tobacco has dabbled in, but their main, their main revenue driver is cigarettes, and their heatless or vaping tobacco lines have been up over 20% per year. So they're getting some growth, and between all the issues that are happening with Juul right now with the FDA, I definitely think it's a safer bet than most of the other small cap tobacco stocks. So I definitely think that this is a pretty rock steady company to add to your portfolio. And if you just look at, if you invested in British American Tobacco versus the S&P in 2007, so immediately before the crash, and then you have, so the worst possible time to invest in either one of these realistically, you would have outperformed the market by about 1% based off just the dividends. If you take out the dividends, you still beat out the market just kind of the same. But you have a company that realistically doesn't do much. It is down, I think, close to 40-ish% on the year. and it is still beating out the overall market. The market's been going up at a very high rate the past couple of years, and because of how massive these dividends are from British American Tobacco, you're still beating out the market. Their current dividend sits around, I believe, 6%. Their payout ratio is, it's a bit skewed right now because of the whole acquisition, but I think it sits around on the 5-year annual around 40%. And, you know, so they don't have to worry about their dividend going away. They're going to continue to make money. And once, you know, the sky starts falling, people are going to start to gravitate towards SIN and other consumer staple stocks in order to, you know, kind of solidify their portfolio moving forward. And so I highly think that right now it's trading at a discount. If you look at its book value, it's at a 1.27. If you look at Altria's is about 6 or 7. And that's mainly because a lot of investors started to sell off because they thought that they paid too much for the Reynolds acquisition. But if you look at what they accumulated, how much their revenue has increased, and now that they have, you know, just a wider portfolio of, you know, options, I think it was a relatively wise investment. I don't think they overpaid too much. I think they could have gotten a better price, but I think net, they're essentially just a bigger company. Like the amount of assets they acquired were more than the liabilities that they took on to pay the debt. So obviously it's going to drive down the book value. And even excluding that, even before the acquisition, this company was trading at somewhat of a discount compared to, say, PM or Altria. So those are just a couple of reasons why I think that this is a pretty good rock in your portfolio. Let me know what you guys think. So those are the 3 stocks that I have picked up for the month of November. You know, pretty much will get you ready for any type of situation that we could be going into. So unless you want to hold cash, obviously. But anyways, so if you guys want any in-depth analysis on any of these companies, make sure to let me know down in the comment section below. And thank you guys for watching. It really means a lot to me, and I hope you got some use out of this, and I will catch you guys in the next video. Peace.